From time to time, firms have more cash on hand than they need, and if a firm is holding excess cash, they need to invest that in a security that is readily convertible back to cash in case they need the cash in the future. So to the extent that a firm has a little bit of extra cash, and it may even be a lot in some cases, and they don't have another use for it in the short term, they are going to want to purchase marketable securities. So marketable securities are funds held for other than immediate transactions purposes, and they're going to earn a return. They're going to earn an interest rate. There are a wide variety of different short-term investments, different marketable securities, and we'll turn to these in a little more detail in a moment. One of the important things to recognize about marketable securities is the relationship between the maturity, the time to maturity, and the interest rate. As a general rule, and there are always exceptions, but as a general rule, the longer the period until maturity, the higher the interest rate. If the firm thinks it's going to need its money back in a hurry, it's going to invest in a shorter maturity security, but the negative to that is that they just aren't going to earn as much interest. The borrower is willing to pay more when they know they're going to be able to wait longer to make repayment. There's less risk to the borrower, and they're willing to pay more for that. So the very, very short-term maturities, and here we have as an example, we'll look at the first item here. These are short-term Treasury bills, and by short-term we mean these are in months, 1 month, 3 months, 6 months, and you'll see there's a slightly upward sloping line here. The longer the time until you have to pay back, until the maturity on the Treasury bill, the higher the interest rate. So this line is slightly upward sloping right here. Down in the lower half of the screen, you see a description of long-term government securities. So by long-term, instead of in months, we're talking about 10 years to maturity, or 20 years, or 30 years. And the longer the time to maturity, again, the higher the interest rate. Now, one of the things that, this is really purely for illustration, one of the things I would be careful not to overinterpret is, let's look at the interest rates here and here. At any given time, interest rates are likely to change, so but they will usually have the same upward slope. So when we look at the point of intersection of the zero number, we should interpret that very loosely, which is to say this may be true 1 month, the next month we might have a line that looks like that. We have a different interest rate. The slope of the line might change from time to time, but the general shape is almost always upward sloping. On very, very rare occasions you'll see a downward sloping rate relative to maturity dates. When that happens, historically that's been a harbinger of significant economic declines, recessions, but it's very, very rare even before a recession. So let's clean up just a tad and turn our attention to the next item, which are the types of short-term investments. We're going to look here at essentially 3 types of short-term investments: federal government securities, Treasury bills, for these are all short-term, Treasury bonds are long-term, federal Treasury bills. Treasury bills have maturities of 3 to 6 months. They're extremely safe. They're as safe as the federal government's ability to pay its debt. It's a huge market. They're very, very marketable. Second, we'll look at is federal agency securities. They're a little bit longer term. They're extremely safe again and very marketable. There are huge numbers of these securities that are traded on a daily basis. A little bit less marketable, and we see that here, are various non-governmental securities. Because they're less marketable, they tend to pay a little higher rate of interest because there's a little more risk involved. Still, on the whole, because they're short term, these are fairly safe. There's a significant, the safety level is good. The marketability, depending upon the security, is from very good to none at all. There's some savings account, for example, you can go take your money out, but you can't sell your savings account basically to somebody else. The same thing with money market funds. But let's go back and look at these in some detail. Let me clean up. Okay, there we go. Let's deal with these one at a time. We'll start with Treasury bills, and you'll see over here to the right we've got several time periods, and you'll notice that back in 1980 we had interest rates that were almost 15% for short-term instruments. 30 years later we see extremely low interest rates. We probably are looking at over the last 75 years the highest and the lowest rates that you're going to observe for Treasury bills, and sort of in a sense these are likely to be upper and lower bounds, although you never know for sure what the future is going to hold. To sort of simplify things, looking at these in a cross-section, because the 2010 period is unusual, as is the 1980 period, we'll sort of look at the securities in that little blue box in 2003, which we think of as being sort of somewhat more normal period, although interest rates are historically fairly low here. So to first of all discuss these Treasury bills, we've got 3-month bills, 6-month bills. As you can see, the interest rates are a little higher with the longer maturities. Treasury bills are short-term obligations of the federal government, and they're popular. It's a place to park funds because the market is very large and active. Even though these securities were originally issued with maturities of 91 to 182 days, investors can buy an outstanding Treasury bill that has as little as 1 day remaining, and because these Treasury bills are issued on a weekly basis, the company almost always has a very wide range of choices in terms of maturity. Again, these have really excellent marketability. They're very attractive for parking funds for a short term. Clean up a little bit. The next item here, we see a Federal Home Loan Bank security. Notice that it yields slightly more than the Treasury bills do. In general, these federal agency securities are issued by governmental organizations like the Federal Home Loan Bank, or Fannie Mae, or Freddie Mac, Sallie Mae, that's the Student Loan Marketing Association, and they don't have the direct backing of the U.S. Treasury, but as a general rule there is an implicit guarantee that the government will step in and make payments if the issuing agency can't. And in fact, that implicit guarantee was explicitly enacted, I guess that's the way to describe it, recently when Fannie Mae and Freddie Mac essentially were bankrupt. and the federal government stepped in and said, we are going to make this implicit guarantee explicit. As a general rule, these securities have a little bit longer maturity, but they are still extremely safe, highly marketable. There's a huge market for these. This brings us to a third, or I guess a fourth. We'll look at the various non-government securities, and we'll consider these certificates of deposit. Large certificates of deposit are for typically $100,000 or more. A certificate of deposit is offered by a commercial bank, a savings and loan, or other financial institutions, and the investor places his or her funds on deposit at a specified rate over a given period of time, and that's essentially what a certificate of deposit is. Some of them are as short as 3 months. You can also purchase certificates of deposit for several years. As a short-term investment, you're obviously going to want to, or a company's going to want to use a shorter time period. The interest rates on certificates of deposit, typically for the large CDs, they're a little bit higher. You'll see that in these other periods. In 2003, they were awfully close to one another. Typically, the large CDs are a little bit higher. The federal government guarantees bank certificate of deposits up to $250,000. So, having said that, while you can trade these certificates of deposit, the small ones, because there's really minimum value here, there's not a very good market for that, and even for the large ones, they aren't as tradable as, say, Treasury Bills or federal agency securities. Commercial paper is issued by large corporations, and essentially it's a promissory note. It's an unsecured promise, similar to a certificate of deposit. Having said that, it's not backed by a federal guarantee, and as a result, it typically is going to trade at a little bit higher interest rate. So you'll see here typically higher interest rates, although in 2010 we have an unusual market, and so it's a little less clear. Now the reasons that you might see a lower rate might be because the commercial paper may on average have shorter maturities really than some of the certificates of deposit, but in general they're a little less risky, or they're a little more risky than bank CDs, but there is a market for commercial paper. Ford Motor Company, Ford Motor Credit Corporation frequently will issue commercial paper. It just rolls it over every few months, and that commercial paper is used to finance car loans and other operating activities. Let's clean up. Bankers' acceptances are short-term securities that arise typically in foreign trade. The acceptance is a draft that's drawn on a bank for payment when it's presented to the bank. And the difference between a draft and a check is that the company doesn't have to have the funds on deposit at the bank to cover the draft. Instead, when the bank has accepted the draft for payment and presented it to the company has to provide the funds at that point. you can probably think of a banker's acceptance in terms of its marketability as similar to a check, and that a check can be endorsed over to someone else. There's actually, for these banker's acceptances, there's a market that exists because an exporter that holds the banker's acceptance might have to wait several months for actual cash payment. Rather than waiting, they might sell that banker's acceptance. Another popular international short-term investment that arises from foreign trade is the Euro-dollar certificate of deposit. The rate on this investment is usually higher than the rates on U.S. Treasury bills, and you can see that right here. Euro dollars are U.S. dollars held on deposit in foreign banks, and in turn lent by those banks to someone seeking dollars. Now, the euro dollar doesn't have to be in Europe. That's just a term that's sort of more generally applied. Since the U.S. dollar is the principal foreign currency that's accepted worldwide, any country can use it to help pay for goods purchased through international trade. Therefore, there's a very large market for euro-dollar deposits and loans. The last couple of items that we have here: savings accounts, money market funds, money market deposit accounts. Savings accounts are used more often by relatively small companies. The money market fund is also of some interest. The money market fund takes small deposits from investors and then bundles it together to purchase higher yielding certificates of deposit, perhaps like the large CDs for $100,000, but rather than one individual or one company buying $100,000, numerous the money market fund will buy $100,000 CDs, and people who purchase or provide the funds to these money market funds will share in the benefits there, the value. There are some costs associated with it, but it really opened up the large CD market, in a sense, to smaller investors. There's also the money market account that's sort of modeled after money market funds, and that's the last thing listed here at the bottom. And essentially that allowed commercial banks, savings and loans to offer very similar sorts of investment options. So as we can see here, there's a very wide array of different types of short-term investments, and for large companies, they're going to be more likely to invest directly, perhaps in certificates of deposit, in Eurobank, Eurodollar deposits. There may be directly in Treasury securities, and smaller corporations are going to consider some alternative investments. But there are a lot of different alternatives with different levels of safety, different levels of marketability, different sizes to invest, different maturities. The main thing is companies don't want to be sitting with unused cash on the balance sheet. To the extent that they have cash that isn't required for transactions in the short run, they're probably going to want to invest in a marketable security, a short-term investment of some sort.